Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. So, I finally looked up what hedging really means and what I'm trying to accomplish. So, um, hedging strategies would be more like if we did um, options or selling future contracts or short selling, or what I was getting at yesterday, which was inverse ETFs and collars, which is also kind of a options derivative thing. Um, but what I'm trying to do is actually diversify my portfolio because when I was watching my portfolio go down in the recent market, I was surprised at how SVOL was doing. And I was hoping that in a a down market, that it would, you know, not go down as much as my yield max funds, which are single stock ETFs. So there's not a lot of diversification in yield max because you are taking on the risk that it is a single stock ETF. So if that single stock goes down, your holding also goes down. So I don't want to diversify for the sake of diversification, but if I can do something to not lose as much money and even gain money during the next sort of crash that we get, this was probably like a tester. Well, there is a increased amount of probability for recession as far as I know, but we're not in a recession yet, and it might be a few months until we are. So now is a good time to take stock of your portfolio and say, am I properly diversified? And how can I hedge against this? So I did a bunch of back testing, and on the left hand side here, we have these sorted by the max drawdown. So we have fiat, which is the inverse of Coney bond, total bond market, O, which is real estate, gold, which is gold, goalie, which is a weird gold that I found last night after we did our video. TLT is treasury bonds, SCHD is following the S&P 500 but focused on value stocks. VOO is the S&P 500, UDT is based off of the NASDAQ 100, SVOL is shorting the VIX, Misty is MicroStrategies, but it's also a play on Bitcoin, and VIXY, which is the volatility of the market. So VIXY is dead last in max drawdown, but it is number one in gains in that time. So I'm going to go out on a limb, and from the very little bit of research I've done on VIXY, it is with big warning labels, and it's kind of it's a bad long-term investment. I'm just going to say it like it is. Do not invest in VIXY, except for when SVOL is super down, because it will rocket up. But you have to put in your trailing stop, because this thing will drop quicker than a lead balloon, and you will lose 100% of your money, guaranteed. It's actually kind of insane how much it was. It was like, and we look at VIXY over here. I like Misty VIXY. Okay, so like if you pot in at $15 and all of a sudden it's at 13, that's not great. Over the last, is this going? I don't know what's up with Google Finance. Okay, so see how it's like $10, $10, $10, and then it jumps up to 22, and then it very, very, very quickly tapers off. That's what I'm talking about. Like, it just, will not end well for you if you don't put in your trailing stop. Buy in at the beginning of the market panic. Let it peak up here. You have your tiered trailing stop, 5%, 10%, 15%. And then by the time it gets to here or here, you've already sold automatically. You don't really have to worry about it. But if you go here, it just, like, you are going to lose your money if you are in here for the long term. But if you're in the midst of a bad market and it's green, you take your chances and see if you can actually gain a lot of money in the downturn. It's just the super warning labels of like, do not stay in there long term. As soon as you start losing money and it goes down, please sell. It's dangerous. But anyway, so fiat had the second, it has the least drawdown and it has the second most amount of money, which is probably why I'm going to wind up with like a 25% fiat and 5% something else, or 70% Misty, 20% fiat, and 10% my actual diversification from this. So I actually did ask Perplexity again of buying an unrelated asset class, because I thought that was also a hedging strategy, but that's more of a diversification strategy. And what I would like to do is, well, diversify, but not just for the sake of diversification. But something that I can get a monthly income, or it'll stay steady while we don't need it. Just what I'm interested in is hedging my Misty and VIXY. So maybe as a hedging strategy, buying the inverse really is the best option, because when Misty and NVDY go down, fiat and drips, or I think it's drips, whatever it is, the opposite of NVIDIA, those should be doing well. And this is only like the second month, I think, of fiat. Like last month was the first time it paid out. But so far, it's holding its NAV. So it might be a situation where we can get 100% yield on Misty and 100% yield on fiat. So then, and both of them are holding their NAV. So it's hard to tell someone that it's actually a bad choice. But O actually was the third least drawdown, and it had the third most amount of money, which tells me that if I want to use diversification, maybe I should look into more real estate funds and see what are my options. Because if I could just own real estate and be a yield max slumlord, when I take out margin, I don't have to worry so much. Like, Misty drew down 22.5%. And I only had 25% more margin, less than 25% margin. But it was still like, I don't know about this. But if I had, 5% of my portfolio, that was O, or 10%, maybe I would feel better about going into these things. Actually, let's try this. So I just had a huge list of just testing this all singly. So if we have like 70% Misty and 20%, 200%, 20% fiat, and then 10% O. And we backtest this. Well, so I'd have $9,000. That's not so bad. If I did VIXY though, like a total degenerate, I'd still have about the same amount. I think the real issue here is this needs to be lower, and this would need to be higher. And then we're getting closer to it being 10%. So if my hedging strategy was half and half here, that does not equal to, we'll just do 70 here again. We're so close. 60, 20, 20. Okay, yeah, so if we did 20% fiat, 60% Misty, and 20% VIXY in this situation, if instead of doing something super volatile that will wipe you of all of your money, we could do something like this and still not have all of my money, but the max drawdown is 9%, which is way less than 22.58%. It's hard because what if it's just like 30 and 10, and we don't want to overfit to backtesting. I just think this is interesting. It doesn't make any difference, so that's nice. So I'm going to probably make a series of uninformed videos like this where I'm trying to grok my way through making sure that I'm hedged, but this is probably more like diversification. I need to figure out more real estate. I know that O is popular. I don't know if it's the best one. And more precious metal options, small cap, mid cap, whatever variety of bonds that I could find, utilities and financials. I was watching a YouTube video today, and they were just saying what markets would be good in recession, and basically small cap. Well, it was in a recession. Like they were talking about recession proofing your portfolio, but they were also talking about with rate cuts in particular. With rate cuts, it's the small cap, some of the bonds, utilities, and financials do really well with the rate cuts, which have already been priced into the market, but still. Yeah. So I just wanted to do this again where yesterday I was trying to figure out what should my diversification be, and I believe I was settling for doing a mixture of fiat and QDT, which it actually also ranks this far down on the list for how much the markdown was, but it also Doesn't quite give me the $10,000 back. But it is high income. Like, it's been paying a 60% annualized paid weekly. So is it better to accept the risk of, fiat and the QDTE combination, just so that I don't have to buy more ETFs in my portfolio? At a certain point, it does become confusing about what I even hold and for what purpose if there are too many ETFs. So I don't think I tested, like, I'm getting tired, but the YouTube video I was talking about there was a different YouTube video, and the person that was talking was actually praising SVOL, because they said, like, oh, well, it actually, over the last 100 days, has recovered and been green. I just remember at the time, it sucked to live through that, and it's making a drawdown that is close to the equities that I have, like my yield max. Everything was going down, and I had enough margin buffer to not get a margin call, but it would have been nice to be able to know that VIXY existed and play around with it. So yeah, they were saying that even though there was a big spike, they did not lose 99.9999% of their value, and they're still outperforming the market, S&P 500. So it's actually a pretty good fund that pays a relatively high yield at 15 to 17%. So still not happy with SVOL because I didn't realize that it would move in the same direction as equities, and I am equity heavy, so a little bit of diversification will not harm me. In fact, will probably be good for me in general. And now I know that VIXY exists, even though it's a bad idea. I think that if there's ever a July 29th ever again, and I can see that SVOL is just tanking, so like here, when SVOL's going bad and you get this up here and you sell, and then you don't experience any of this, that would be nice. But yeah, I think that VIXY is a bad idea, just in general. But it is nice to know what I could desperately do during a market downturn in order to get a spike of profit to balance out my portfolio. So anyways, I'm gonna go because I'm feeling myself just get super tired. So I will see you later. Bye.